Zoom is a video conferencing platform that lets people connect remotely through high-quality video, audio, and chat features. It's widely used for virtual meetings, webinars, and collaboration, offering tools like screen sharing, breakout rooms, and recording options. However, the stock price is down 85% from its all-time high back in 2020. Zoom is a company that has a market cap of $24 billion that did $4.5 in revenue in the last 12 months. Of that, 875 million was profit, which puts them at a PE of 28. But as you can see, the forward PE is 15, which means that net income is expected to grow a lot next year. Regarding their financials, their revenue logically grew massively during COVID. However, in the past years, revenue growth has slowed down substantially. Their net income took a hit in 2022, but is back to growth and it is currently at $875 million. However, their free cash flow has not stopped growing and is currently at 1.7 billion. Moreover, this company has great margins. As you can see, gross margin has been around 75%. Profit margin, like net income, took a hit in 2022, but is back to growth and is currently at 19%. And free cash flow margin obviously has been much higher and is currently at 37%. Then, in order to calculate the intrinsic value of the company, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. As you can see, the intrinsic value according to it is between $38 per share and $116 according to net income, and between $51 and $122 per share according to free cash flow. And the stock is currently trading at around $78 per share. Moreover, this means that if my low assumptions occur, you're going to make a 2.5% annual return on your money, middle 10.5%, and high 18.5% according to free cash flow. Regarding my assumptions, I assumed 0% annual revenue growth on my low assumptions, 3% on the middle, and 6% on my high. A free cash flow margin of 27% on my low assumptions, 33% on my middle, and 39% on my high. And I want a bit lower on profit margin because as we have seen, it has been lower. And this is the reason why the intrinsic value according to free cash flow is higher than the one according to net income. Finally, I assigned the 16, 18, and 20 P and price to free cash flow to the company at the end of the 7 years and left the share outstanding change the same. The spreadsheet does not attribute any value to the balance sheet, and Zoom has an exceptional balance sheet as they have $7.5 billion in cash and only $64 million in debt, which is truly amazing. Zoom is reporting earnings next Monday and are expected to make $1.16 billion in revenue and $1.31 per share in EPS. It's very probable they beat on EPS as they have beaten the previous 4 quarters. And if we take a look at what analysts are expecting in the future, they are expected to make $5.51 per share in 3 years and $5.1 billion in revenue. Finally, some famous investors that have owned this stock are Michael Burry and Cathie Woods. Michael Burry bought at $72 and then sold a few months later at $66. And Cathie Woods bought when the stock was nearly at an all-time high and then has sold and bought a few shares. In conclusion, I believe Zoom is trading at a good value. They have an amazing balance sheet and they have great margins. However, the main question that I have with this company is if it is a one-trick pony and if they can get back to growing revenue, which is why I am personally not interested in this stock at the moment. But remember that this is not financial advice and you should always do your own research. I hope you found this video valuable. Let me know what you think about Zoom stock in the comments and I'll see you in the next one.